And so they came back and they said, we don't like the pitch. We don't really like the business idea. We don't think the team has enough venture experience, and you don't have enough revenue. But if you can fix those things, we'd love to chat.
Wow.
It's like, what is left? Like, that's everything. That is the entire business.
Layer 1 is a podcast and community dedicated to helping you master all things crypto. We'll be bringing you the best interviews with project executives, technical analysis for trading of the most popular cryptocurrencies, and insight into what's actually happening behind the scenes.
As you join us each episode, you're going to hear about tokens, fundraisers, investments, and even crypto conspiracies. But please remember that nothing we say should be considered financial or legal advice.
Come join us on this journey, and welcome to Layer 1.
Alrighty, ladies and gentlemen, we are back with another episode of the Layer 1 podcast. As always, we've got another awesome guest for you here today. But before we get there, before we intro a friend of mine, somebody I've known for a good little while here. He's been in the crypto space for a few years now. Obviously want to kick it over to Q, see how he's doing. Q, how you doing in the quarantine?
I'm a friend of yours too, Mike. Come on. I'm doing great, man. I'm quarantine week, whatever it is. I thought Sunday was Monday this week. So, that's how it's going with me. We do have another great guest. We have Jesse Proudman, CEO of Strix Leviathan. It's going to be a great episode. We've had a great run. We're like par and par with Pomp, man. I really feel like we're killing it on the guests this past month. So, Jesse, how are you doing today, man?
I'm doing well. It's day 42 of quarantine here in Seattle. Just hanging in there.
I see you've been marking actually, so you know the exact day.
So
we'll definitely talk some COVID, but we want to get into your background, man. You have that awesome background working at IBM. You had a company that was bought by IBM as well. So we want to get to your background, maybe even before you were at Blue Box, and then as you got there, and then working your way into the blockchain space.
Yeah, absolutely. I've been a lifelong entrepreneur. Started my first company when I was 13. The previous company, Strix, was called Blue Box. I started that in 2003 from my dorm room at University of Puget Sound here in Tacoma, Washington. It was the first business license the city of Tacoma had ever issued for a dorm room. I think probably first and only. So that company was a managed hosting company, effectively like Rackspace. Sort of these were, this is how you ran a website before Amazon Web Services existed. And so bootstrapped that company for 9 years, and then ultimately raised about 22 million in venture to take the tech we'd built and use it to launch a private cloud product. IBM kind of caught their eye with that product and ultimately bought the company in June of 2015. It was a great exit for the team and for me and the investors. And we were excited to be at IBM. Spent about a year and a half as a distinguished engineer at IBM working on integrating that product inside of the broader IBM cloud offering. And then the last year I was at IBM, I worked with IBM Ventures. So they had an initiative to launch an accelerator program. Microsoft has Microsoft Accelerator, Google has Launchpad. IBM didn't have sort of that kind of that program to interface with the startup community. So I designed a program for them, and then my job over 2017 was effectively to become the domain expert in the crypto space. So all the time you could be paid to research crypto, that was a really great and fun time to be doing that. And it's kind of funny, I went to college actually with Nick Carey from blockchain.com and Eric Voorhees from Shapeshift. We were all in the same graduating cohort of this business leadership program. And so I'd watched over their shoulders as they had built their businesses over the years. But 2017 was really the first time I'd had an opportunity to dig into what was happening in the space. And sort of anybody that's been involved here at any time, I think it takes 3 or 4 months of really intensive reading and research to kind of get the lay of the land. And so by the middle of 17, I was hooked. This reminded me of kind of internet circa 97. Like you've got these networks that are functional, but all the user experience is pretty abysmal. And that's where sort of all the action was. And so IBM at the end of Q3 came to the conclusion they weren't going to put that accelerator live, offered me a role working on Hyperledger, their private blockchain product. I'd have to relocate to New Jersey. And as good as that sounded, I decided I wanted to start something on my own again. And so left IBM in December and started Strix in January of 18.
Yeah, and time has obviously flown since then. You've been in a variety of different businesses. Blue Box, obviously, kind of the most successful with that exit to IBM. What was that process like, both in, as you said, kind of pulling that along and bootstrapping that business? I know when I was in Seattle last, you kind of mentioned that briefly, as there were many a night after work where beers were downed or whiskey was down or whatever the case, because it was just so stressful, right? As is any small business. But to go from that to then an exit with IBM, what was that process like, and maybe what are some of the things that you learned or took away from that process?
Yeah, the whole Blue Box story, it like in hindsight, it feels like something that never should have played out the way it did. Like it should have died on the vine multiple times. And I mean, from the point I founded the company, we went through the 08 recession. We lost 60% of our revenue sort of over the course of a couple months. We got into this as a hosting company, your business is to run the servers that power fast growing websites, right? So our clients, and a lot of them were sort of Facebook or MySpace games way back when. And so they would go from sort of no popularity to be very popular, to either sort of not being popular again, or they'd get acquired. And so we'd scale up their infrastructure for them, and then they'd either go out of business or they'd sell, and the acquiring company would run their own infrastructure. So we had this really nasty pattern of our largest customer sort of disappearing every year on us. So that's as a bootstrap business, right? You don't have the sort of the cash coffers of a venture-backed business to rely on. So we did that for years. And then finally in 2010, I realized like we needed to do something differently. Like this was not emotionally sustainable or economically sustainable. And so it felt like there was an opportunity to take the technology we built to run that business and do something different with it to kind of make that more of a software business than just a hardware business. And so I went in 2010 to go raise venture capital, pitched 45 different investors, got 45 no's. It was an arduous and difficult process. I made every mistake in the book. I was kind of a first-time founder, and sort of went into a period of mourning after that.
What were some of the major mistakes? Like, give us one or two that you wish you could tell yourself back then, and then redo that scenario.
Yeah, I mean, the largest was just time of year. Like we were pitching in the middle of summer. And every VC goes on vacation in the middle of summer. So whether or not, even if you get somebody interested, like their partners are on vacation. So everything just slows down. So being really cognizant around time of year, I think was important. And obviously, we were not the best deal, right? I think if you have this really exciting deal that's out there, like people and you're top tier, like people chase you down and they'll call in from vacation. But if you're just sort of some B-rate deal that is an interesting investment, is a good business, but isn't sort of the next big unicorn, like that's a harder pitch to get people excited by. So that was a big struggle. And then we were doing silly stuff. Like we're based in Seattle, so we'd pitch a VC in Seattle, and then we'd fly down to the Bay and pitch a VC in the Bay, and then we'd fly back to Seattle to pitch another VC the next morning. And say, like, it just didn't coordinate the schedules right. And I think I went at it sort of just being excited to get a meeting versus being cognizant about calendars. So it's sort of out of the pavement too much to some extent, and your own exhaustion becomes sort of detrimental to the broader process. And it's funny, I don't know, there's 45 no's that we got. Like this is classic venture. You don't ever get a reason, right? It's just, and you don't ever really get a no. Like most of them just start ghosting you. Some of them will tell you, check back in when your revenue's higher, you've hit these milestones. So there's all these challenges with kind of understanding where you sit with the actual individual investors. The only investor that actually gave me any reasoning was Voyager Capital here in Seattle. So they came back and they said, we don't like the pitch. We don't really like the business idea. We don't think the team has enough venture experience, and you don't have enough revenue. But if you can fix those things, we'd love to chat. It's like, what is left? Like, that's everything. That is the entire business. And so
go ahead.
So I went to this period of mourning, like they literally don't like anything about what we do. How do I reconcile this? And so for the next 3 months, I was just kind of dour. And then I started to kind of pull my head out of the sand and realized, all right, like our pitch was awful. And if I go back and look at that original deck, it was not a good pitch. So like check for them on that one. The team, we had a great team, but to be fair, they didn't have venture experience. We were all sort of, we were all experienced business people to some extent, but not from the venture world. So that was a fair piece of commentary. And then the revenue is what the revenue, where revenue was, what the revenue was. It's sort of nothing you can do about that. And so tried to effectively fix the first two issues. And so went and found an executive to join the team with venture experience. Revenue just sort of naturally grew, again, sort of by luck. And then we spent a lot of time on the pitch. Went back the following year, 2011, and tried again. And I think that year I pitched something like 37 investors or 35 investors, and I got one yes, which was from Voyager Capital here in town. So I went back to them. I said, hey, you said these are the three things that were wrong. I've changed the team up. We have a better pitch, and revenue kind of changed. And we love your thoughts on it now. And they were incredible. And to sort of say, all right, like we like your business. You've built sort of something interesting here, and you can listen. I think sort of humility in entrepreneurs is something that is often far removed, and people don't take oftentimes advice or suggestions very well. So being able to demonstrate that you can take feedback and do something with it, I think benefited us in that scenario. But yeah, it was a struggle to raise capital at the front end, and then once we had capital, it was just more of a struggle. Like we lost our largest customer, Facebook gaming company, like the day after. I was in the midst of diligence, I think, for the venture deal. Like they told the Voyager called them to do diligence, and they told Voyager they were leaving before they told us they were leaving. Like that should have killed the deal immediately.
Wow.
And so it just became this sort of comedy of errors. That executive that I hired with venture experience, turned out he was a sociopath, had sort of made up his resume, we had done reference checks, but I mean, the reference checks passed, but I had some relationship with those folks.
Wow.
He ended up embezzling about 50 grand from the company. Like we had to hire police to sort of escort him out of the business. Like that was a debacle. And then he had set off a bunch of work that we had to finish. Like he basically started moving a data center. We had to finish that process. And that ended up costing like 3 times more than we originally had thought it would.
Oh my God.
So we went from, we've just raised like $4.3 million, like we're king of the world, everything's going to go super well, to now our largest customer is leaving. Like this data center migration is costing us 3 or 4 times more than we thought it would. The executive that we hired to kind of run all this just embezzled a bunch of money.
Goodness.
And is a total sociopath. And so we had closed that original round in December. I get my years all mixed up on this. We closed it in December, and by October of the following year, we were functionally bankrupt. Like on the phone with bankruptcy attorneys, being like, "Well, you have to now like sign a letter of engagement with us on this call because this call can't be discoverable because, by all intents and purposes, you are legally bankrupt." We pulled together $1.5 million bridge rounds from the original investors, which again, like that should have killed us. They should have creamed us with the terms, but they didn't. That gave us a couple more months of runway. That got us to February. February, we did some layoffs, like made a bunch of structural changes. We were able to raise about another $3.3 million in structured debt from Columbia Pacific here in Seattle. So at the time, the way that structured debt product works, you effectively borrow $3.3 million and you owe them about $5.4 million. So it seemed like incredibly expensive capital to fund the business. Like in hindsight, after going through the IBM acquisition, it wasn't. We can talk about that in a moment. But like somehow we pulled that one together. So sort of like all of these dominoes that fell, that like any one of them shouldn't have played out that way. But by sort of February, in the midst of this, I realized like I'm an experiential learner, which means I make mistakes. And in a startup, that means that costs you money. And we were just out of money for me to continue to make mistakes. And so I effectively came to the conclusion that for my own sort of for the value of my own equity in this business, particularly now having been sort of 10 years into this thing, I probably needed somebody that could make fewer mistakes to run it, and effectively decided to go hire a new CEO at that point and kind of change my role. And so I went out and found a wonderful gentleman named Matt Schultz. We did the professional dating thing for a couple months, and I met his wife and he met my wife, and we met the kids, and we did all the things and all the reference checks. And it was the sort of, having gone through the sociopathic hire, we went as far to the other end as we could in terms of making sure it was the right fit. And he joined in May of that year, and it was just a phenomenal ad. You know, I think as an entrepreneur, you are most successful when you can play to your strengths. And my strength was not running the business. My strength was being the sort of chief evangelist, being out and publicizing what we were doing, setting product strategy, working in the code base and with the engineering team. It was not fundraising, sort of managing the board, managing the executives. Sort of that realization and being able to get somebody in that actually was good at that was such a game-changing moment for the business. And so that May hire effectively started off the path to that IBM acquisition. This Matt had just come off of another similar company called Tier 3 here in Seattle, a very similar hosting company, just targeting sort of .NET or Windows workloads versus what we were targeting. And hiring him kind of indicated to the market that, hey, maybe we're open to acquisition offers. And so we got approached. There's a big annual conference every year in May. We got approached at that conference by a bunch of parties, and that kicked off the first acquisition process. So from May to effectively October of 2014, we went through the whole M&A song and dance. And you know, much like the original venture process, we kind of did this one backwards as well, but with a little bit more guidance. You know, I think M&A is such an interesting process because you're basically playing chicken with all these multi-billion-dollar companies, trying to get them to buy your business and bluff your way to higher valuations and trying to sort of imply that there are other deals on the table. It's a really fascinating art. We very fortunately worked with an investment banker, Eric Mandel from Guggenheim in New York, who sort of Matt, Eric, and I became this strategy threesome, sort of figuring out how to play the cards right with all of these parties. But we went through that whole process, and we made a ton of progress. We got 2 offers. It was like, oh, this is finally the moment we're going to sell this business. And it's just like 11 years of my life sort of manifested in a potential outcome. And we finally get these term sheets, and we got 2. One was for like 26 million and one was for like 25 million. And after all of the venture we'd raised at that point in time, I would have walked away with a meaningful amount of money, but not 10 years worth of your life amount of money. And that was a devastating moment. Sort of realizing like, oh, this is it. And this is what we've come to. And again, we were kind of running short on cash. So like, well, if we don't take these, like, what are our other options? Right.
Kind of pushed into a corner a little bit there. Yeah.
Yeah. So we ended up flipping one of those offers into a Series B raise. And this one is fascinating. So that company offered us, I think it was maybe the $25 million offer to buy the company, but they offered to invest, I guess it was $8 million on a total of 14. So they're going to write 8 of a $14 million note on like a $40 million pre-money valuation. So we were worth more independent than we were worth if they bought us. Which again, it's like that. None of this makes sense.
That's funny looking back on that. Yeah, for sure. I mean, obviously you guys have many kind of highs and many lows, is the case with startups, but you kept pushing, right? It's over 10 years, you know, coming up on 11 years, coming up on 12 years now at this point, as you're getting closer to kind of that final acquisition from IBM. What did that process, I'm sure that's what you were getting to, but what was that process? What was that final kind of moment of relief almost when that whole IBM acquisition started happening?
Yeah, absolutely. So we started that in February of 15. So I think from the very first conversation we had at IBM's conference in Vegas to the day of close, I believe was about 101 days, which was the fastest acquisition IBM's ever done. It was the most sort of emotionally charged 100 days of my life. Right? You think like any startup is really a roller coaster, and you'll have a good day and you'll have a bad day, and some weeks you'll have a couple good days and a couple bad days. And it's just that you swing back and forth. Like in this 100 days, you'd have an amazing moment and the world's worst moment in the course of an hour.
Wow.
So we got, I mean, the diligence process, for example, IBM's due diligence questionnaire was, I think it was 1,700 questions in an Excel document, some of which are like, provide every contract that you've ever signed in the history of the company. And some are like, have you ever imported or exported hardware to Iran? Right. So some are super easy. Some are nuts. The company at the time was 65 people. We had 17 of us working on it. It took us 14 days to finish that due diligence questionnaire. And I think we produced like 86,000 pages of documentation. That was the fastest due diligence process, sort of the document production that IBM had ever seen. They sent, again, we were 65 people. They sent 45 people out to Seattle to do on-site diligence. We had to rent out the basement of the Westin. And again, there's only 17 of us working on it, right? So there's 45 of them kind of spread out in all these meeting rooms and 17 of us kind of running back and forth. And it's funny because they have like the marketing guy in one room and they have the sales guy in one room. And we only have one sales and marketing guy. So he's like he's running back and forth between the rooms trying to answer the questions. We get to the very last day, we're supposed to close, and IBM came back, or IBM's lawyers came back with some final silly term that we needed to change.
Of course.
And I remember it's like the last minute, everything's signed, all of our board members and investors had signed off on everything, and now we got to change all this again. It's like, it's one of those moments where you think this is going to kill the whole deal. And that day, we were in the office until 4 a.m. I went home and I slept for an hour and a half and then came back to the office at 6 to kind of get everything closed. So you have no energy left. You're at the end of the sprint. You're just exhausted. But like you said, you just you push through. And we got it done. And it's interesting. Like, I'm not a big believer in waiting for things. So we had, my wife and I were living in a pretty small 2-bedroom house with our 2 kids, and we'd lined up a new house to buy as part of this acquisition. And we used the term sheet from the acquisition as the contingency on the house purchase. So the deal closes, like we close that afternoon. My wife has met the moving truck and is now moving us into this new house. And so I go from like 100 days of total stress to meeting her at this new house to unpack everything. And we wake up the next morning. Yeah. And it's just like, is this real? Like, what? This does not feel real. Who's gonna wake me up and tell me I've been dreaming? Sort of like one analogy is you think about it, like you have 14 years of stress, your fist is just totally clenched for 14 years, and then you wake up one morning and your fist is released. It was the weirdest feeling, and it took me like 45 to 60 days before I started to feel any sort of semblance of normalcy. It felt so otherworldly for so long.
All right, Jesse, this is what we're going to do. We're going to end the episode here. We're going to do a part 2 next week, because that was like a full episode in and of itself. I do want to kind of fast forward. I want to touch on one thing. I had a question about IBM in one of your, I wouldn't say recent videos, but you were at some meetup about a year ago. You were talking kind of the inner workings of IBM. You kind of named 5 key factors they were working on, or sectors, was just security, mobile, blockchain, cloud, and machine learning. And you definitely like specified that blockchain and machine learning were like apt to be one of their more successful ventures as they go forward. Is that still the case? Because I know that was a year ago. And then give somebody an idea of how a company as large as IBM goes about all of these initiatives and how they're going to go about blockchain and machine learning.
Yeah, it's a great question. So I will caveat by saying I've not actively tracked IBM in the last year or so. So a lot of this is anecdotal based on my experience there from a couple years back. I think so. IBM effectively runs all of these these initiatives as individual business units. So the machine learning team, that's the Watson team, that's all the ads you see. The blockchain team is run as its own business unit. The woman that runs the blockchain unit, Marie, is amazing. So inside of IBM, I mean, I think this is one of their biggest challenges. Like, it's a couple 100,000 people. Within that, you've got some really amazing folks, and you've got some folks that probably shouldn't be there anymore. And it's really like business success on a business unit by business unit basis is ultimately about who you've assembled in that team. The blockchain team from the outside, I never sort of worked as part of that group. They seem to have done a very good job bringing together the people you'd want in that team. I think that the challenge is that a lot of what IBM was trying to do or continues to try to do with blockchain, you don't necessarily need the blockchain for. Some of the things are phenomenal, right? Like the food tracking services that they're building across sort of multiple counterparties, or some of the shipping initiatives between Maersk and different ports. Like that type of workload makes a lot of sense. But there was always this struggle to try to figure out, like, what do we do with blockchain? And by the time I left, like, I don't think that question was necessarily answered. And out of the industry, I don't think it's necessarily answered that question. Because IBM didn't want to touch the currency side when I was there. I think that's changed a bit over the last 2.5 years. And in my eyes, the currency side is one of the primary meaningful use cases, if not the only meaningful use case right now. So I think they've got a smart group of people. They've certainly got capital to pour after it. My biggest question is there enough sort of enterprise interest that will generate meaningful revenue to make that a long-term sort of supporting part of IBM's business? And the entire crypto community has been sort of championing this, like, the enterprises are coming mantra for the last 2.5 years, and they're not necessarily, they're not here yet. And so it's like, I think they will ultimately enter the space. It's just a matter of, does IBM have the patience to wait for that to actually happen? Interesting.
Well, as you moved from IBM to Strix, right, back into a startup role, obviously different than Blue Box was, but understanding all of the stress and the ups and downs and the roller coaster and that whole process with Blue Box, I would imagine the urge or kind of the pitch around Strix that you gave yourself was pretty strong, right? It would have to be after going through that full startup process, having that super meaningful exit. So how did Strix come about, right? What was it that really sold you on Strix as, really this data backed or quantitative hedge fund that you guys are running now?
Yeah, it's a great question. I mean, I think, again, as an experiential learner, like I want to do something that sort of tickles a new part of my brain. And so as I was doing that research for IBM in the blockchain space in 2017, like I just was staring at enough of these trading charts day in, day out, and you stare at these things and you start to see patterns. And I was like, if I can visually see patterns, I can programmatically see patterns. And the blockchain space is fascinating to me, largely due to the data transparency that's here, both on-chain data, which is interesting. We don't use a ton of that today, but more importantly, like all of the exchanges that exist in this space provide everybody publicly accessible streaming trade data. Like I can't go to the New York Stock Exchange and for free get access to real-time trade matches.
Right.
That doesn't exist. And so in the crypto world, you've got that, and you've got it off every exchange around the globe. You've got an asset class that has liquidity and trades 24/7. There are all these sort of interesting characteristics that started to make this seem like a really sort of interesting thing to explore. So Q4 of 17, I started to prototype some software to see, hey, is this actually even possible? And got to the end of the year and concluded like, oh, this is possible. This is interesting. It's something new. And it feels worthwhile to just to give it a shot.
And at the same time, obviously, Bitcoin is, approaching 20K at that point, and I'm sure everybody in their mother is like, "Hey, Jesse, when can we buy some Bitcoin?" Right?
Right, exactly. So it's funny. My co-founder Sadie Rainey, I went back and I looked. I sent her a text message, effectively saying it was 3 days after the Bitcoin all-time high. Like, do you want to go start this business with me? Our timing could have been better, but yeah, it was definitely this moment of frenzy in the space. And so that made it certainly easier to be excited about the business. It made it easier to raise our original capital that we needed to launch the company. There were a lot of benefits around what was happening in the space at that time.
Yeah, for sure. So for those who don't know, right, maybe people listening here are kind of more holder types. Maybe they trade a little bit of Bitcoin, but what exactly is it that Strix does? You guys use data a bit. I know we've talked previously about some of the work that you guys do with stable coins. You have basically built out over the last 2 years a pretty impressive system for portfolio management and back-end reporting. So if you were to describe Strix to somebody who doesn't necessarily understand what a quant fund is or hasn't heard of Strix, right? What is it exactly that you guys have done and are working on now?
Yeah, so at the very highest level, we're quantitatively traded crypto hedge funds, which means we ingest a bunch of data, we analyze that data for patterns, and we make trading decisions based on those patterns with the objective to outperform sort of a traditional buy and hold approach. And sort of the next layer down, when we started this business, we had thought there would be a lot of tooling available in the space for vehicles like ours to go use to, whether it's to like ingest that data or make the trading decisions or go execute those trades. And we quickly realized like there's nothing here for sophisticated funds. And so we spent about 2.5 years building this end-to-end platform that provides portfolio management, order execution, settlement, reporting, sort of investor tracking, everything that a fund needs to effectively operate in this space, we've built from the ground up. And it's all like in the traditional world, all of these tools exist. So we've had to build all of this infrastructure that we shouldn't necessarily have had to build, but we've built it. And now we think that gives us a fundamental leg up on a bunch of the competition. Like if we look at the rest of the fund space, there are so many funds that are literally using spreadsheets to manage their operations. And that's terrifying. Like to manage millions of dollars of other people's capital in a spreadsheet feels irresponsible to me. And so making sure that we had a better way to do that was sort of a big part of our day one approach.
Yeah, it's interesting that you've kind of found your way back into developing some type of product. Obviously, you had that that acquisition, and you moved into investing. That's the standard route, right? And I imagine it was a real stress reliever to not have to develop a product. So up to this point, with that platform that you're building, that terminal there, what has the process been of maybe getting this out to the public, getting this out to the institutional investors that it was made for?
Yeah, when we started, we effectively founded the company with the objective to be able to sell that software as a standalone offering. So we have our own fund, and that fund licenses our own software from another vehicle. So we've got kind of two sides to our business. We pretty quickly realized like there just aren't enough businesses in the space to support a standalone business selling that kind of software. Like if you step back, there's probably give or take 500 total funds in the crypto space. That includes venture funds, sort of ICO flip funds, like actively managed quant funds like ours. So like that's your universe. You have 500 prospective total customers. Of that, you probably have like 50 maybe that are doing any kind of actively managed trading. And of those 50, most of them are small. They're like $2 to $10 million funds. And all these $2 to $10 million funds are paying fees to their TPA, to their third-party administrators, to their custodians. And so everybody is sort of getting nickeled and dimes to some extent and is very cost conscious. And so you've got this really small set of potential customers that all are cost conscious and don't really want to spend much money. Like we looked at that and like, this is not a great business. Like we're not going to be able to go sell this software and make a material income to support the development of the platform. We also sort of realized that if we built something unique here, like, and we're running a fund, it probably makes sense to use that to differentiate our own fund in the space. And so we pretty early made the decision to focus solely on our fund and let that software platform sort of benefit our investors and not use that vehicle as a kind of a standalone offering. And kind of in hindsight, I feel really good about that decision. I don't think there's enough money in this space to support revenue for a business like this. And I don't think we were capitalized well enough. Like if you look at some of the other folks that are doing similar things like digital assets data, those guys have built a piece of what we've built. They've raised $22 million, right, to build a piece. You look at like SFox or some of the other trading platforms, like those guys have raised $20 million to focus on trade execution. So you've got all these well-capitalized competitors that have built a sliver of the aggregate stack that we've built, like all the settlement and record-keeping sites, like Luca has raised 20 million plus to do that. So I just, like, the market is oversaturated with well-capitalized competitors who have piecemeal solutions. Just didn't feel realistic. So
yeah. Yeah, and obviously a giant network as well, right? I mean, we're, under Product Capital, the teeny tiny self-funded fund that we run. We've been bombarded, from folks like Tagomi and a variety of others who, like you said, just kind of run one sliver, but are well capitalized and can kind of soak up that market share via networking or advertising or whatever it is. So, running a quant fund in crypto, I would say, at least from my perspective, is different from a lot of what you see with your typical crypto venture funds or typical crypto Bitcoin long only funds, right? Where basically the funds at a broad level have a thesis around, hey, this is a revolution in money. This is, new access for so many people around the world to an alternative to a parallel financial system. But as a quant fund, really you're looking for, as you've said, patterns and using data to kind of pull alpha out of the market. So, outside of Strix, right? You as someone who has been in crypto now for a few years, what are kind of your thoughts on crypto at this point, whether it's Bitcoin specifically or crypto as a brand new emerging asset class? March 12th was a crazy day for crypto and for Bitcoin as well. So, just kind of generally, where do you see this whole industry sitting at this point?
Yeah, I think we're at a pretty challenging moment in time for the industry. I think 2017 was a pretty phenomenal year, certainly in terms of returns, but largely in terms of exposure of this asset class to a broader community. And unfortunately, most of the retail investors that got involved in 2017 have been hurt pretty badly in terms of their return profile and their investments. And so you've got, it's like, who, in my eyes, the Bitcoin price goes up when there's more demand than there is supply. Like, it's pretty simple. And the question is, where is that demand coming from in our eyes? Like, who is going to supply the net new capital that will cause the next bull run? And following 17, the sort of argument was it's going to be the institutions. The institutions are coming. They're going to bring all this new capital. That has not panned out. I think it's not panned out for a number of reasons. One, that, again, the tooling is awful in this space, so it's hard to interact with. Two, there's a bunch of regulatory concerns that these traditional institutions have, and we've had to deal with it as well. Just trying to deal with fitting a new asset class into the rules and regulations that exist for traditional finance. Like, it's not easy, and I think that's keeping a lot of people out. And then three, I think it's an incredibly volatile and sort of odd space, right? Like, it takes the returns are enormous, but they're also filled with 80% drawdowns. Like, you've got to have a stomach to be able to handle that, or you have to have a strategy or approach to be able to not deal with those drawdowns. And that's not your traditional investor. Like, if you go talk to family office, if you talk to high net worth folks, if you talk to institutional investors, like, they do not want an 80% drawdown on their balance sheet. They'll take a smaller return profile that is sort of drawdown with significantly less drawdown than something that can go up sort of 1,000, 2,000, 3,000%, but have that 80% drawdown characteristic. So that's kind of the concern I have. And so if it's not that institutional capital, and most of retail that was exposed in 2017 has been burned, like, where is that new capital coming from that's going to support the growth of the space? So I see it's a demand issue. I think a lot of people will look at the halving coming up here in 20, 25 days or so, and they'll point to sort of the stock to flow model, and they'll say, oh, well, it's going to be solved because supply is being cut. We don't buy into that at all. I think there are a lot of issues with the stock to flow model. I also think that there's a limited understanding around how mining as an industry has changed over the last 5 years. Like, we are at this we're at this point in time where you can't go back and look at the last two halvings and use those as a point of reference for what will happen in this halving, because mining has changed dramatically. We have these industrial scale mining facilities with balance sheets that are measured in millions of dollars or hundreds of millions of dollars. Those operators are going to approach this entire halving process so differently than sort of the hobbyist miners that existed at the first halving, or even that you can call them industrial miners at the second halving, but much smaller scale than what was happening today, right? So it's like, yeah, the block reward that's being emitted from the minting of new blocks every block period, like that is being reduced. But those miners don't go and sell that block reward that they receive every day. Like there is a whole speculative nature that exists in that mining community that I don't think people are really thinking about. And March 12th was a great example of that. A lot of the sell-off, I think, was triggered by margin calls from leveraged miners. If it's not like, if we have a supply issue, we don't have a bunch of new capital coming in, or excuse me, we have a demand issue, we don't have a bunch of new capital coming in, and we've got all this supply question. Like I don't know what drives price up from here.
Yeah,
that's the big question we keep asking ourselves.
Yeah, that's been my thought as well. You know, at long term, I think some of the ripples, if you will, from this crisis and this pandemic, which we'll certainly get to with you being based in Seattle, but some of those ripples I think will be good for Bitcoin and kind of this concept of a choice when you look at a financial system, even if it is still super early, right? Maybe we need another 10, 20 years, whatever it is. But in that short term, like you said, retail have been burned. And to me, March 12th and that giant unwinding of leverage was one where if you looked at that exact moment, I know it doesn't apply now after we've seen Bitcoin recover quite a bit, but at that moment, Bitcoin was hit the worst. So if you're your venture funds or your kind of more institutional types, or even those who are just going out and selling to RIAs, right? If that store of value concept in 2 hours roughly was demolished, how do you go back to those tables, right? How do you go back and try to sell that pension fund on Bitcoin as being a good store of value or diversified in a time now where it's been rather correlated. So as you kind of look out, right, maybe it's not in 2020, maybe it's not in 2021. What do you think could be a catalyst for some of those institutional players coming back in, whether it's on the investment side or the tech side or whatever it may be?
Yeah, that's a great question. I don't know. To be honest, I don't know. I think the industry has sort of a marketing issue. Originally Bitcoin was this medium of exchange, like you could use it to pay everybody for things. That kind of went out the window. Then it was this store of value argument. And like you said, I think March 12th demonstrated or created a lot of question around that. And at the end of the day, it may be a wonderful store of value, but again, it's fraught with these drawdowns. Like psychologically, you can make a 10% gain or a 50% gain, like you can feel pretty good, but you take a 50% loss, you feel sick to your stomach. Like it's just, the losses hurt so much more than the gains. And people kind of forget that. And like we deal with this all day long in our business, right? Like we take losses, we take drawdowns in our fund, and we always have to remind ourselves that's just part of the system, and we have to be okay with that, and they hurt. So we got to figure out, the industry is sort of in this marketing crisis mode, and like, why do we exist? Why are we here? I mean, I think that there is something interesting to me about sort of this currency that exists outside of the traditional financial system. Like we just did a blog post a couple weeks ago where we're talking about like, why are we participating in this space? Like that is interesting to me. Whether or not it's a store of value or medium of exchange, like I could care less. I do like the fact that you've got something that sort of sits outside of the bounds of traditional assets, whether or not it's correlated now or in the future or in the past, like it doesn't matter to me, but it's different. That's interesting to me. And so I think trying to figure out what that pitch is going to be a big challenge for folks, because we sort of lost credibility as an industry with much of the sort of drum banging that has been done over the last 2 years.
I honestly think you could take an optimistic approach too and view it as we kind of survived, and every time it survives an incident, I think you could say you get stronger, right? But it's
But don't,
interesting
don't like don't you think like it's terrifying that like a single exchange almost brought the price to zero. Like
yeah.
Zero.
Well,
it's commentary on the industry, right? It's like we are not, it's, as much as we'd like to think we've evolved so much since 2017 and things have become very sophisticated. Like we still are reliant on a handful of exchanges that are unregulated and they're distributed around the globe to set price. Like I think it's yeah. It's
no, it's a fair debate, and I think I would love to hear your thoughts on these circuit breakers and whether they're needed in crypto. And somebody back in the day they fat fingered sold Ethereum to like 15 cents, and now you see all the DeFi lockup that's happening on Ethereum. So you could claim that okay, we survived that. I do get the institutions not wanting to lose 60% of their capital in overnight. So I understand that. I understand that truthfully. So it is interesting to see these narratives kind of evolve over time, right? Like Bitcoin at one point was not a store of value, and you could almost claim after that crash that it's not, the narrative's lost. But as over time, I felt like it started to get this store of value feel. ETH kind of has that same vibe. As more, ETH gets locked up in DeFi, you kind of can make the argument that there's a store of value aspect. How far down CMC are you guys talking about when you say Strix Leviathan is working with large cap, tokens within crypto? How far down? Where? Like, we're in the jungle over here. We like to invest in 100, 1,000 down CMC. How far are you getting down that market cap list when you talk about, okay, we're working with large cap cryptocurrencies?
Yeah, we're so we're right at the top. I mean, so if you think about what we do, the signals effectively move us in and out of positions with pretty relative frequency. And so when we execute those trades, we need to make sure that the execution costs, so that includes both the fees we pay to the OTC desks that we work with and the slippage that we experience off of spot, like the combination of that needs to be within the bounds of the models that we've historically created. And the top five, so Bitcoin, Litecoin, Ethereum, Ripple, Bitcoin Cash, like all of those have a liquidity profile that is predictable. Like we know what we will pay to get in and out of a trade. As soon as you move from 5 to 10, that gets a little bit more questionable. It's still there to a large extent, but it's more questionable. Like BNB, TRX, Tezos, like all of these, they have liquidity. You think they have liquidity, and then when you try to need to move a big position in or out, that liquidity can often vanish. And then anything below 10, it's like it's ridiculous. We had experimented with things like ETC or XFR or Zcash. And these are markets, and we think they're really interesting. Like we think there's a lot of elements about them that we like, but you try to move even like $100,000 worth of capital through them, which is not a large trade for us, and you can see execution costs upward of 2.5%, which doesn't work. Like it just doesn't work in our models. So that's kind of what we monitor. We look at liquidity in markets, and we trade the markets that we think are liquid. That's not to say that's just it's how our models are built, right? That's not to say things further down there aren't benefit in. I think there's a lot of projects that are interesting, but you just have to take a different approach. You can't actively trade something with liquidity as limited as many of the markets in this space.
Yeah, when I hear terms like vanish, it gives me like odes to Flash Boys and talking about those bots and algos and everything that happens in the traditional markets. What are the roles of bots and these algorithms within cryptocurrency right now? Do you think it's completely dominant by these processes, or do you think it's retail driven, or if it's institutional driven? What is the role of bots and algos within crypto right now?
Yeah, I think sort of traditional crypto Twitter gets this confused a lot, and just because I think a lot of the OTC landscape or the market making landscape is just foreign to many folks. So when you think about how these exchanges operate, there's effectively market makers that are prop trading desks that have built algorithms that kind of keep liquidity on both sides of the book. And when you buy or sell, you're effectively, by far and large, buying or selling from one of those market makers. And there's not a lot of them in crypto, right? There's probably 10 to 15 total, and there's probably 3 to 5 that really matter. And those are the folks that are providing material liquidity to most of the markets in the space. I think that the algorithms, the bots, like there could be sort of market makers that are here because they like making markets, and there could be market makers that are here because they like sort of manipulating markets. And I think you can look at sort of patterns in order books, and you can start to identify entities that are more on that manipulation side. And manipulation, I think, it's a word that could be challenged, but there's definitely, because liquidity is thin in a lot of these markets, there's ways to move price around with order books and with algorithms that doesn't exist in traditional markets or wouldn't be permitted in traditional markets. So that's a challenge that I think exists in this space. It's not necessarily, I don't think it's a detriment to the space. Like it's something to be aware of, right? It's like you're on the front lines here, and you need to understand sort of who you're trading against or trading with, and that's part of the reality.
Let's talk about Strix Leviathan as a term, right? I see you got the Kraken, or you got some Leviathan on your cup there. Strix Leviathan as the term, where did that come from? And then we'll touch on a couple more things going on in crypto, including like stable coins and DeFi and things like that as you see it.
Yeah, so this is kind of a fun one. You were kind of asking earlier, like, what did I think about when I was starting this business? There are a couple of things that we wanted to make sure could happen. One, I wanted to have a business that we could contain the employee count. Like I didn't want this to be a 100-person, 50-person business. Two, I wanted to have something I could have fun with, right? And so part of that was we didn't need sort of a consumer name. We wanted to have something that had some meaning. So for us, sort of Strix Leviathan, it's effectively an owl and an octopus. An owl is sort of big brained, always listening, or always watching, very intelligent, right? So that to some extent represents our platform. Like we're always out there streaming data in real time off of all these exchanges. We're watching everything. And then an octopus, big brain multitasking, right? Being able to take all that data and make a lot of simultaneous decisions with it. And so those two animals sort of pulled together to represent what we wanted this business to be. And then we needed something that sounded cooler. So Strix is sort of an owl of the night, and a Leviathan is obviously like a sea monster. But playing off those terms, at the end of the day, we want a platform that's always watching, always listening, and multitasking in real time. And we think we captured that well.
Yeah, for sure. That definitely makes sense. We had gone back and forth, you and I, a little bit on Twitter about stable coins. Obviously, over the last few weeks, stable coins have absolutely exploded, mostly Tether, whether it's on the Omni blockchain or the ETH blockchain. But I know you guys do some work with stable coins. Feel free to get into that if you'd like. But where do you see stable coins going in the future, understanding some of the macroeconomic backdrop with the US dollar, and obviously the ease of access that hopefully should even continue to improve with stable coins? Do you think long-term stable coins are here to stay, or are there certain hurdles that they need to get over at this point?
Yeah, I love and I hate stable coins simultaneously. Like anybody that's ever sent a wire immediately sees why a stable coin is great. It's just such an easier way to transmit US dollars that have a consistent recognizable value to and from counterparties. And that's super interesting to me. We have, at various points in time, we've market made for stable coins. Like on Binance, you used to be able to sell 1 Paxos for $1 US coin and make 20 to 30 basis points.
Yep.
Selling $1 for $1 and making 30 basis points at a time, that goes ridiculous. A lot of those opportunities have been arbed out. So we don't do a ton with the stablecoin market outside of some yield generating offerings today, using some stablecoins as a way to generate yield off of our cash. But I think they're incredible sets of technology. The market is really confusing to me right now. Like if you go pull up the Tether market cap over the last 12 months, that is not a natural looking graph,
right,
at all. Like nothing goes up $1.2 billion in a day logically. So there's something really weird there. And there's always been something really weird with Tether. You know, we're not believers that the whole thing is fraudulent. Like I think there's a lot of people that would make the argument that Tether has been used to manipulate the price of Bitcoin. Like I don't necessarily believe that, but it also doesn't look natural, and they've certainly not been entirely transparent with their operational history, and that brings me a lot of concern. Which is why like things like US dollar coin, which is sort of the flip side, like they're trying to be as transparent as possible, start to make a ton of sense. Given the kind of the broader economic backdrop, like I have some concern because when you think about like what is a stable coin, it's you're taking dollars and you're giving them to somebody else who's putting them in a bank account, and then they're giving you a token that represents those dollars. So now you're reliant on that third party continuing to exist as a business. You're reliant on the bank that they selected continuing to exist as a bank. And you're reliant on effectively that capital that they're sitting on being able to generate yield for them, for the issuer that provides their operating capital to sustain their operations. And in the global climate that we're in now with yields, with sort of global yields going to zero or potentially negative, like it may start costing you capital to store your money in a bank. And if so, like what are these stablecoin companies going to do? Like they are going to be charged to sit on this cash. Are they going to like charge the stablecoin holdings? Like I think there's a lot of uncertainty there that is to be determined.
Yeah,
it's kind of like, you know, Bitcoin has never gone through a global macro recession, right? Bitcoin started in after the last large recession. Same thing with these stablecoins. Like they've not gone through a period of time where there is instability and fragility in the banking system, and I think there is a lot of counterparty risk that's just unknown.
Yeah, for sure. I mean, basically what you're getting at is the fact that these stablecoin issuers will take the cash that they've received. They'll obviously issue the stablecoin, and that cash that they've received, they'll go and they'll buy short-term bonds. So if they're using those bonds traditionally for some sort of yield, and those go flat or negative, right? What do they do? And maybe the worry then becomes that they start messing around with weird derivatives, or perhaps there's some sort of consolidation where now you only have one or two major stablecoin issuers, at least in the U.S. And then at the same time, you have the giant regulatory overhang, right? We're starting to kind of get some of the FUD or the rumors going on of stablecoins starting to get the attention of regulators more and more now with this kind of USD crisis. But flipping it to the other side of the coin, if you will, with the traditional markets, I want to talk a little bit about obviously, you know, COVID and this whole process. You know, I've got to admit, right? Like you were one of the first people on my Twitter feed who maybe it was based on your location or the information you were getting or whatever it was, but you were one of the first person on my feed that was saying, hey, this is going to be a big deal, right? This is going to be really bad. It's already a problem in Washington. And this was at a point where I think a lot of people still weren't sure that this was going to affect them, whether it was in their big city or their small town. So maybe we start with kind of when you started to first hear about this, and I don't want to belabor the point too long because I know it's not a super fun topic, but what was that like? And, you know, where does Seattle and Washington stand at this point as the entire country, the entire world continues to fight this crisis and this pandemic? Yeah,
well, this has obviously been a tragic worldwide pandemic, and it's unfortunate to see it sort of play out as it has. My wife has family in Taiwan, so we were some of the paying attention very early in January as sort of Taiwan began to shut its borders to Chinese travelers. Around sort of Chinese New Year, and kind of watching what was happening in Wuhan, we were pretty cognizant of that and kind of beginning to change some of our behaviors in our family. Like we didn't go to any of the Chinese New Year celebrations this year in Seattle, largely out of sort of respect for China, trying to think through like if China can't celebrate these, it doesn't feel right to be doing that here. But then sort of as the first patient landed in Washington, like that's when we started to take it pretty seriously. I'm immunocompromised. I'm on some immunosuppressants as part of an arthritic condition I have, and so I'm already in the risk category. And when that first patient landed in Washington, that's when we really just took sort of initial precautions, stocking up on food, making sure we sort of had our plans ready, not knowing what exactly was going to come. The outbreak at the nursing home on the east side of Seattle, like that was the first real indicator that this is a big deal and this is going to get much, much bigger, much quicker. I think I'm fortunate that part of my job, like I just read all day long, and Twitter has created this incredible avenue to get access to data from all over the globe in real time. A lot of it's junk, so you gotta have a high filter for what you're reading. But you started to see these data points emerging very early on in February and beginning of March that did not paint a pretty picture. And you can start to pull those data points together into this narrative. And it's like at the end of the day, it felt more appropriate to be prepared than it did to play this off as not a big deal. And I think that's the mistake that we've made. It's like at the end of the day, if we had as a country, as the United States as a country, taken this more seriously at the get-go, we likely would not be in the situation we're in now. Certainly with the economic shutdowns that we've had, like we blew containment at the front end, and that's the hope was we could have contained the thing from day zero here. Like we blew it. So that's the challenge.
Yeah, one of the debates going on is kind of these people that believe COVID's like the apocalypse. That's the one end, and also on the other end, COVID's just the flu, right? Like it's just another strain of the flu. Being immunocompromised, what do you have to do on a regular basis as it comes to the regular flu?
Yeah, it's pretty sad. I just take flu shots every year. Like there's not a lot else you can do. But try to stay healthy. Like wash your hands. And I agree. Like this is, it is a flu strain. It's not going away. It's going to be part of our global population for the foreseeable future. The issue for me has never really been like, it's not like Ebola where you're sort of getting it, you're doomed, right? The issue for me has been two things. One, it's been the fact that you could be asymptomatic and spread it. Like that's problem number one for me. And then problem number two has been the amount of medical care required to effectively cure somebody's infection. And so if you go back, like I did a blog post on May 12th, where my biggest concern, the fear I had, was overwhelming the hospital system and that leading to significantly more deaths than the actual infections themselves. Like that's the concern to me. It's not necessarily sort of the severity of the illness. I think it's very severe, but the concern is how do you make sure that the medical systems in the United States, medical systems around the globe don't fail catastrophically and create this huge ripple effect that isn't being thought about. And
that we saw in Italy.
Right. And that's, it's nice to see like sort of Washington, Oregon, California, they're beginning to kind of think through, all right, how do we reopen? Well, we got to look at these 5 or 6 points around, how are the hospitals prepared? Are they stocked with PPE? Do they have enough capacity to take another surge? Like this isn't going away, right? A vaccine will be sort of what ultimately cures us in the global population. And that's not, like, we're still 12 to 18 months away in my eyes from that, despite what anybody says. And so between now and then, like, what do you do? Well, you just got to make sure that you can kind of keep the waves of infection under sort of that ceiling that permits the hospitals to kind of take care of people.
Yeah, for sure. Basically what you're getting at with the vaccine there is that it's not only going to be a little bit of time before quote unquote everything goes back to normal, but I think there's a growing belief that things might not go back to exactly how they were, right? We talked a little bit about BitMEX here, and Arthur Hayes put out a great blog post that we were talking about on the live show we do on Mondays. And one of the things he said was literally, can your brain go back to January 2020 pre-COVID, right? How much has this affected people in a way that it will thus change their actions? And we had this debate a little bit on Monday, and generally maybe it's more of a cynical approach that I take, but I don't think that it's going to drastically change the majority of people's actions, right? If you look at the entire 350 million people, however many it is in the US, I would imagine that whether it's on the health side or the economic side, that unfortunately people may, at least in my opinion, go back to doing exactly what they've always been doing. For those who don't do that, right? Maybe whether it's a minority or majority, whatever, we know there will be great differences in the way that people take care of themselves from viruses or go to public gatherings or whatever the case may be. What are some of those changes that you think are going to happen, and what could be some of those ripple effects in crypto or in general business? I mean, we've seen Zoom explode, right? We've seen Netflix and Amazon do really well. Where do you kind of see all of the puzzle pieces fitting in the future?
Yeah, this has been a fun one to think about in a lot of ways. Like, I think at the end of the day, you've taken 320 million, like you've mentioned, and you've basically put them into the great pause. Like everything is paused in their life. And now they're all dealing with the economic ramifications of that. Like most Americans don't have enough cash on hand to get through this. And as soon as sort of things open back up, everybody's been like, in my mind, it's like PTSD. Everybody's been shell shocked to some extent. And with empty bank accounts, like people, I think this is going to create this savings culture, and will have a pretty meaningful impact on the consumer culture that we've had in the country. I think that lasts for a period of time. I think you're right. I think long term, you look at the next decade, like 10 years from now, are people going to still sort of be fearful and conservative in their spending patterns? Like, I don't necessarily know, but certainly for the next year, 2 years, 3 years, like this is going to, it's seared in all of our memories, right? And we've seen that in our own household. Like we've talked a lot about trips we've wanted to go on or things we've wanted to get. They just don't feel meaningful anymore. Like we're not motivated to go do those things. It's really changed our perspective on life and what's meaningful and important. I think that is going to have pretty meaningful consequences on the broader population. The Zoom one's really interesting. Like one of the things we've been trying to think about is sort of the corporate culture of offices, right? Like for so long, the argument has been we can't permit work from home because it just doesn't work for our business, right? And now everybody's forced to do it, and it's working just fine for most businesses. Like there's certainly plenty of businesses that aren't able to do that, but for many, it's functioning. And so when this is all done, like is there this big desire for everybody to run back to the office? Like it'll be interesting to see how that plays out, and then what impact that has on the commercial real estate market. I read there's one blog post of a woman talking the other day about how she's picked up 2.5 hours of her day in commute time because she doesn't have to commute every day, and that's given her this opportunity to learn more, to read, or to have time with her family. When we moved, my commute went from 45 minutes each way to 10 minutes each way. Just that extra hour a day, it's life changing to a lot of extent. And so sort of in this great pause, as people realize like, oh, I didn't actually have to be at the office to get everything done that I need to get done. Like there's not going to be this desire to clamor back to the office. So that'll, I think, that will be one of the largest changes I think we get out of this, and how long that one lasts will be really curious.
Yeah, I always felt like automated cars were going to accomplish that fact where you have a 2-hour commute, but you could work while doing that. But it looks like we might not go to work at all here in like a couple of years. But no, I do definitely agree with your statements there on like just retail in general and kind of the population spending habits. I completely agree. I'm not a fan of the way the government's going about kind of bailing out the any big firms or any big companies every 10 years. It's just like a cycle. In 10 years, we're going to do it all over again. So not a fan of the socialist approach there. This was a great, interview, man. We touched on a lot. If you have anything else that we might have missed on Strix Leviathan, or any last thoughts on kind of the macro markets that you want to hit, we can. Otherwise, I'll go ahead and ask this final question. Did you have anything?
Yeah, I mean, the last piece is kind of thinking through the recovery. Like there was a report that came out a couple of days ago here that the average Seattle business has 18 days of cash on hand on their balance sheet, like the average business, right? And so we're now, I mean, I'm on day 43 here. Seattle's been locked down in aggregate for fewer. The target now is sometime in May. So you think about like one of our largest restaurateurs in Seattle, Tom Douglas, he spent $3 million just to shut his business down. Like that's what it costs to pay out all of his employees, to kind of deal with all the leases. So how, like, I don't know how he starts that back up. And so that's, you think about it, it's like you don't just hit play again and everything goes back to normal. Like there are costs that people have incurred to shut things down, and there will be costs that people have incurred to start things back up. particularly on the restaurant side, we're friends with a number of restaurateurs. They're not going to go hire everybody that they laid off the day everything opens back up, because the demand isn't going to materialize the day everything opens back up. And so there's like everybody that makes this V argument. I think you just got to think about all these individual pieces that kind of play into that. On the flip side, like I heard that 2021 cruises are booked out, which makes no sense to me. That's a death wish.
Who in their right mind is doing that?
Right.
Cruise people are doing that though. I mean, that's kind of a funny thing I've heard from comedians is cruise people are different people. If you're going on like 4+ cruises a year, you have no fear.
Yeah. So it's going to be interesting. It's going to be interesting kind of next couple quarters, I think. And anybody that tries to call it has no idea what's actually going to happen.
Yeah.
There's so much uncertainty that will play out. But,
yeah, the answer has to be, I think, government subsidies, right? Like, I hate the government subsidies for the big airlines that are leveraged up to $1 billion, in the banks, obviously, but like government subsidies for small businesses and giving, good processes for like starting businesses back up and things like that has to come from the government. I don't see how else that can happen. But hey, last question we had for you, it is a favorite book. We always like a book recommendation. It could be crypto, it could be non-crypto. Just any book. Also, I want to get your thoughts on who to follow on Twitter. I know you said you follow a lot of people for like good data and good stories there. So those two questions, what do you got?
Yeah, so I picked up a book in the midst of all this crisis before Amazon shipping is now out a month, but it's called How to Survive the Aftermath of a Cataclysm, which is really it's fascinating. So I thought it was going to be this bizarro kind of nut job book about kind of survival in the aftermath. It's like a how-to guide of how to make practical things with supplies, which is just it's fun, like brain tickler, like how to generate electricity using an alternator in a river, or where do you go get batteries for your electrical grid when the world has ended. It's been a really fun read. So that's been on the top of my shelf.
How about Twitter?
Twitter's a harder one. So I've built a couple lists. I've got like sort of a traders list and a crypto list, and I just keep taking people off. Like I think so many folks on Twitter sort of pontificate with any actual real knowledge. It's a shame, and so trying to sort through that signal for noise has been challenging. Some of the folks I've enjoyed more recently, Crypto ISO. On Twitter has been a fun one to follow. I think we just think about the markets pretty similarly. That's probably the only one I can think of, like specifically,
sure.
Name-wise. But it's just like crypto Twitter is such an echo chamber with people that don't really understand how these markets work or understand a lot of the fundamentals that make up market structure here. Like it's fascinating.
Yeah, for sure. It definitely is. And your background is one that, unfortunately, I think most people on Twitter who are spouting out, price targets or whatever the case may be, don't, it's a background they don't necessarily have. So we definitely appreciate you sharing that with us today. That the Blue Box story is fascinating. And hopefully here in the coming months, we'll follow up, whether it be good or bad for crypto, good or bad for the global economy, and kind of see where things are with you and with Strix Leviathan here maybe later this summer or in the fall. But for those who are interested in following you on Twitter or learning more about Strix, certainly looking into the end-to-end platform that you guys have put together, what's the best way for them to get a hold of you and the team?
Yeah, so I'm on Twitter just at Jesse, Jesse, Proudman, Proudman, very simple. I don't use a fake name and a fake picture. And then you can go learn more about Strix at strixfund.com, STRIXFUND.com.
Awesome, Jesse. I'll be following you after this, and you can follow me. I don't pontificate on anything, so you don't have to be worried about that. But amazing episode. Like Mike said, hopefully we have you on again soon, maybe in a couple quarters, and hopefully you're doing well, man. Take care.
Sounds great. Appreciate it, guys.
Hey guys, we hope you enjoyed today's episode. Make sure to check out Layer 1 on all the audio and video platforms listed in the description. Thanks for stopping by, and we'll see you next week.